In early February 2025, trade tensions between the United States and Canada escalated following President Donald Trump's announcement of significant tariffs, citing concerns over illegal immigration and the influx of fentanyl into the U.S. Trump declared a 25% tariff on all Canadian imports, with a reduced 10% tariff specifically on Canadian energy products. These measures were set to take effect on February 4, 2025. In response, Canadian Prime Minister Justin Trudeau announced retaliatory tariffs, imposing a 25% duty on $30 billion worth of U.S. goods starting February 4, with plans to extend these tariffs to an additional $125 billion of U.S. goods after a 21-day public consultation. The targeted products include American beer, wine, bourbon, fruits, fruit juices, clothing, sports equipment, and household appliances. Following discussions between Trump and Trudeau, an agreement was reached to delay the implementation of these tariffs for 30 days. Canada committed to enhancing border security measures, including appointing a fentanyl czar and collaborating on a joint strike force with the U.S. to combat drug trafficking. These concessions, some of which had been previously announced, led to mixed reactions within Canada. Despite the temporary pause, concerns persist about the potential economic impact of the proposed tariffs. Economists warn that such measures could increase consumer prices, disrupt supply chains, and strain the long-standing trade relationship between the U.S. and Canada. The situation remains fluid, with both nations engaging in negotiations to find a more permanent resolution before the new deadline. Recent developments indicate that Canada is adjusting its oil export strategies in response to evolving trade dynamics with the United States and increasing demand from Asian markets, particularly China. Canada's oil industry and Canadian pipeline operator Trans Mountain anticipate increased interest in its pipeline system, especially if these U.S. tariffs are implemented. The Trans Mountain pipeline, which can transport up to 890,000 barrels per day from Alberta to Canada's Pacific coast, has been operating at approximately 80% capacity. The company expects that the tariffs will lead to a rise in shipments to Asia, particularly China, as exporters seek alternative markets. The Trans Mountain pipeline expansion, which began operations in May 2024, has tripled the flow of crude oil from Alberta to Canada's Pacific coast, reaching a capacity of 890,000 barrels per day. This expansion provides Canadian producers with greater access to Asian markets, reducing reliance on the U.S. In recent months, major refiners in China, Japan, South Korea, and Brunei have purchased cargo from the expanded pipeline. For instance, in September 2024, Chinese private refiner Rongsheng Petrochemical secured multiple cargoes of Canadian crude. Canada's strategic pivot towards Asia is driven by several factors. Market diversification reduces dependence on the U.S. market and mitigates risks associated with trade disputes and tariff impositions. Asian countries, particularly China, have a growing demand for heavy crude oil, which aligns well with Canada's export offerings. Accessing high-demand markets in Asia presents opportunities for Canadian producers to achieve better pricing and expand their customer base. Despite Canada's efforts to position itself as a leader in climate action, including implementing a nationwide carbon tax, the country continues to invest heavily in oil extraction projects. The Trans Mountain pipeline has become emblematic of this contradiction, as it facilitates increased oil exports to global markets, particularly China. Critics argue that such investments undermine Canada's emissions reduction targets and highlight the challenges of balancing economic growth with environmental commitments. Canada is a significant player in the global oil industry, ranking among the top oil-producing nations worldwide. As of 2023, the top oil-producing countries and their approximate daily production figures were: United States at 12.91 million barrels per day, 22% of global production; Saudi Arabia at 11.13 million barrels per day, 11%. Russia at 10.75 million barrels per day, 11%. Canada at 5.76 million barrels per day, 6%. And China at 5.26 million barrels per day, 5%. Collectively, these top 5 countries account for over half of the world's total oil production. Canada's oil production has seen significant growth over the past decades. In 2019, the country produced an average of 4.7 million barrels per day, with 64% derived from unconventional oil sands. By 2023, production increased to approximately 5.76 million barrels per day, solidifying Canada's position as the fourth largest oil producer globally. Canada boasts the third largest proven oil reserves globally, estimated at approximately 180 billion barrels, primarily located in Alberta's oil sands. This vast reserve base underpins Canada's significant role in the global energy landscape. A substantial portion of Canada's oil production is destined for export. In 2023, crude oil exports reached a record high of 4 million barrels per day, accounting for 81% of the country's total production. Notably, 98% of these exports were directed to the United States, highlighting the integrated nature of the North American energy market. Canada's export economy is diverse, encompassing a range of industries that contribute significantly to its GDP. In 2023, Canada's exports in mineral fuels and oils were valued at approximately $43.40 billion, accounting for a significant portion of the country's export revenue. This category includes crude oil, petroleum gas, and refined petroleum products. The United States remains the primary destination for these exports, underscoring the integrated nature of the North American energy market. The automotive sector is a major contributor to Canada's exports, with vehicles accounting for about $63.68 billion in export revenue in 2023. This includes passenger cars, SUVs, and light trucks. The majority of these vehicles are manufactured in Ontario and Quebec, with a significant portion exported to the United States. Machinery exports, including industrial and technological equipment, contributed approximately $42.46 billion, while electronic and electrical equipment exports were valued at around $16.01 billion in 2023. Key export destinations include the United States and Mexico, facilitated by trade agreements like the Canada-United States-Mexico Agreement, CUSMA. Canada and China have developed a significant trade relationship over the past few decades, with China emerging as Canada's second-largest trading partner after the United States. In 2022, bilateral trade between Canada and China reached substantial figures. Canada exported goods worth approximately $25.4 billion to China, while imports from China stood at about $62.1 billion, resulting in a trade deficit of $36.7 billion for Canada. In 2023, Canada's exports to China were valued at approximately $2.6 billion. Key commodities contributing to this trade included oilseeds and oleaginous fruits at $3.84 billion, ores, slag, and ash at $3.58 billion, mineral fuels and oils at $2.40 billion, pulp of wood and related materials at $2.30 billion, and cereals at $1.49 billion.